Good morning, good afternoon, and good evening, everyone, and welcome to Funding Optionality with special guests from Bank of the West and Astia. My name is Colin Mahan, and I'm a program manager with the NASDAQ Entrepreneurial Center. For those of you who may not know, the NASDAQ Center is a nonprofit dedicated to enabling entrepreneurs from all over the world to realize their maximum potentials and grow. As you may have just seen in the chat, the NASDAQ Center, along with our partner Mentor Cloud, launched a free mentor matching platform for entrepreneurs called Mentor Makers. You can create your own advisory board to guide and inspire you with in-the-moment mentorship from topic experts and professionals dedicated to providing exceptional mentorship to entrepreneurs across all races, industries, and geographies. So find or become a mentor today by using the link in the chat. Mentorship matters to all entrepreneurs. Their success is dependent on it. Now, none of what we do here at the center could be possible without all the amazing support from our sponsors, including NASDAQ, Lehigh University, Bank of the West, KPMG, Wilson Sonsini, Woodruff Sawyer, and BPM. We're grateful and humbled by their contributions. Quick housekeeping, we're going to open up for a live Q&A at the end of the event. So please submit your questions in the Q&A function for our speakers at the bottom of your screen throughout the presentation. Hope to get to them all. Now, during these still unique times, we're curious on how sentiment is among the entrepreneurs we work with. So we're going to start by taking a few polls. One, if you've joined us before, you have seen it. So the first poll is, how are you feeling about your business right now? And the second one is, what's keeping you up at night? These answers help us develop and create the content that hopes to help you, the entrepreneurs that we serve. So let us know real quick on this first poll, how are you feeling about your business? And then the second one, what's keeping you up at night? How can we help? Looks like finance is leading the charge. So I'm going to give this another moment. Don't want to waste too much time. I'm going to share these results. So optimism's at the top of the key, but totally understand that there's a little bit of survival mode and a little bit of anxiety and a tiny bit of fear out there. So hopefully this presentation today will help. Also in this poll results, we've got finance and sales at the top with scale coming up next. So with funding optionality on the brain, I think all of those topics will be covered. All right, final poll before we jump into our discussion. This one will help our panelists today understand where you are in your journey and what they can do to help. So let us know. Have you pursued debt or equity financing? And if so, what kind? All right, so have you not yet? Do you have grant money? Have you raised angel money, venture, or have you had a bank loan? Second one, are you generating revenue? Not yet, yes, but not profitable, and yes, and profitable. So let us know. Appreciate that. Pretty good mix here, folks. So I'm going to end this poll and share those results. So on the first one, a lot of people haven't yet. So this is a conversation for you. And then a decent amount of you have raised grant money, angel investors. There's a pretty good mix. And then also on the revenue side, majority saying not yet, but hopefully you guys are on the road to traction. So without any further delay, please join me in giving a warm welcome in the chat. Let us know where you are to our panel. Paloma is the SME segment strategy, women entrepreneurs at Bank of the West. She's our moderator today. We've got Roxann Burns, who's the Senior Vice President of Small and Medium Enterprise Business at Bank of the West. And also we've got Victoria Pettibone, who's the Managing Partner at the Astia Fund. Welcome, welcome everyone. So looking forward to this conversation. Paloma, over to you.
Great. Thank you so much, Colin. And good morning, everyone. Although I think I should say afternoon and good evening, because I think we have a large audience from all over the world. My name is Paloma Vidgen, and I work for Bank of the West. For those of you who aren't familiar with Bank of the West is a full-service bank operating in 19 states. We offer everything from retail and consumer banking, business banking, commercial banking, as well as wealth management. And we're part of the global BNP Paribas family. At Bank of the West, we're a fundamentally different bank. Our leaders consider issues like gender equality and diversity and our impact on the world when making decisions. And I'm really fortunate to lead our Women Entrepreneurs segment at the bank, where I get to put together strategies and solutions to help women entrepreneurs as they build and grow their businesses. And I'm incredibly excited to be joined by both Rox and Victoria today to discuss funding optionality, which is such an important topic as you get started. So I will love to turn it over to my esteemed colleague, Roxann Burns, to introduce herself.
Hello, Roxann Burns. I have been with Bank of the West for almost 2 years, and I lead the credit for verticals and specialties. And one of those is SBA lending, but also construction, small ag, practice finance, and PAC REM. So I do, oversee lending production. And I have a very long history. Most of my career has been in small business lending, and it's my passion. Thank you.
And Victoria, would love to introduce you as well.
Sure. Wonderful. Thank you for having me today. And for those of you, apologies, I'm stepping in for the wonderful Sharon Bosmick, who had her booster shot and is feeling a bit unwell. But I have been working side by side with Sharon since 2013. So I'll do my best to bring her voice and vision to this conversation as well. Astia is an organization that is 20 years old, always committed to leveling the investment playing field for women entrepreneurs and their teams. We do that through investment. We believe that the best way to change this market, which is very not equal yet, is through actually investing. So we invest through an angel program, Astia Angels. We also have a program called Astia Edge, which is a dedicated fund for very early stage companies led by Black and Latinx women. And then we also have the Astia Fund, which focuses on Series A and Series B investments, always led by women. So happy to share more as we have our conversation, but really pleased to be here today.
Great. Thank you so much, Victoria. So to start this panel conversation off, Rox, this is a little bit of an obvious question, but let's start with the basics. And any of the fundraising scenarios that we're going to discuss today, it's beneficial to have a business account and relationship with a bank. Can you talk about why that is so important?
Yes. I give this advice often to people who are thinking about starting a business. But from an accounting standpoint, you want to start with a business account because you want to be spending money from a business account and not commingling your business and personal accounts. The other thing about establishing a business account, if you personally capitalize your company by making an investment, putting money from your personal resources into a business account, provides a really transparent way of keeping track of equity investments. If you receive equity investments or bank loans, you'll want to put those into your business account. But the other thing that a business account will help you do early on is to build your financial statements, and particularly your balance sheet. And then last, establishing a relationship with a bank can be helpful when you actually start needing bank finance. And I always say it's best to, start with the bank that you have your deposits with. And I also say that's another thing to think about when you're establishing a business checking account is who you establish it with. Who you bank with on your personal level as a consumer may not be the right fit for you as a business person. And I think that's really another thing to consider when you're establishing your business accounts.
Great. Thank you so much, Rox. It's common for many entrepreneurs to use a friends and family round to get their business started. Victoria, can you share advice on how to do this well and what to avoid? And for those who maybe aren't as fortunate to have a great network of friends and family who are able to invest, how should they get started?
Sure. So that first initial money in is extremely challenging because often you are concept stage, right? You haven't built your product. You don't have the money yet to build your product or to build whatever the company is going to be. And so if you think about it, people are investing in your vision. So really they're investing in you. And so that's why it's called that friends and family, because you're really relying on trust and people believing that you can execute on your vision. It is challenging, especially if you don't have that close network of high net worth individuals. And certainly if you're coming from a background, an underserved market, an underserved background, you're less likely to have that. And that is very challenging. It's part of the reason why we've been working to start this EDGE program to be able to provide some of that early seed funding. Luckily, there are more early stage funds that are coming online and early programs for some of that seed funding that are out there. But really, it's about building relationships. And so even if you don't have them yet, you certainly can go out and build them, building an advisor network, building a community, going out to all of those events where you meet with somebody and you don't necessarily ask them for money right away. Think about the long term. Think about building that trust over time and getting people excited about your vision. In terms of structuring it, I think a simple convertible note or a SAFE, which is a simple agreement for future equity, are two instruments that are good to use for that very first stage. Keep it as simple as possible. And just like you should have a bank, I have to say you should definitely consult with a lawyer. I know it's expensive. I know nobody wants to do it, but don't do that first investment without advice of a lawyer, because I've seen really bad mistakes started early that are much more expensive to fix later on. So you want to make sure that whatever instrument you use, whether it's the note or the SAFE, that it's written correctly, that it's, that you don't have any off-market terms included, etc.
Great, thank you. And I really loved your comment about the personal advisory board. I think that's something I've heard time and time again from entrepreneurs who've, made it past those initial early stages, but having that group that they can go to for advice, and hopefully there is a lawyer in there if they're not employing one professionally. So thank you so much for that. Community development financial institutions, also known as CDFIs, are another alternative to very early stage companies. Rox, can you describe how CDFIs work and how a founder can find one in their area?
Yeah. Community development financial institutions are mission-based organizations, and they have a primary objective typically of lending for new business development, economic development, which would be expanding businesses, creating jobs, and housing. And the CDFIfund.gov is a great source of information and will help you find CDFIs in your market that make business loans. And these organizations are lenders. Typically, there may be a few select that will do, equity or grants, but most of them are lenders, and they offer extended terms. But more importantly, they will offer training with their financing. They'll take additional risk for startups. And most of them obtain grants from the CDFI fund, as well as private donors to help fund their loan loss reserves, which enable them to take that extra risk. And as being designated as a community development financial institution, their target clients are, low mod income communities. So this is their mission, and that's what they do, and that's why they're a great source of capital. And just also keep in mind that not all CDFIs will make business loans, so you'll want to check on that.
Great comment, Rox. And I think if you want to learn more, Isis, maybe if we can throw in the chat the video on 8/19. We did a session specifically with some CDFIs if you really want to get into that topic. I would just also like to highlight the point on the education that CDFIs offer. I'm personally on a board for a CDFI in the Bay Area, and they have done above and beyond in terms of their commitment to hours to continue to educate business owners, especially in this pandemic scenario. And I think that's just one of those critical pieces of what they give back to the community. So it's a great place to start. So thank you, Rox. Victoria, you're an angel investor and a VC. What are some of those key components to raising angel capital successfully?
Sure. So, all early stage investment, the investors, especially the individual angels, are thinking about that risk reward balance. And so as much as you can de-risk the risk side of it and then tell a very compelling story for that reward side, you're going to have more opportunity to get that angel funding. And so what can you do to de-risk? Well, the more validation you have, whether that there's product market fit. Clearly that may not be revenue yet, but if you have really good user data, if that's the right, it depends on your industry, obviously. If you're in the medical space, if you have some grant funding, that's a great early validation. If you're in something that's more technology and app, what are your user metrics, even if it's free right now? Are people coming back? Is there churn? Are people using it? The more data that you can put around what you've created, that not only is it a good idea, but there's really a need for it, and you've shown that there's a need for it, then that I think makes it compelling for those early investors to step in. And especially if you have a really clear sense of what it could become, what that exit could be, what that eventual return could be down the road. So being able to tell that story really succinctly in a compelling way, I think is the number one thing for getting that angel funding on board. And then again, it's relationship building. It's all relationships. So remember that you're building relationships now that may eventually invest a year from now, 2 years from now, 3 years from now. But it's all really worth it. Keep track of people. A no is not a no forever. Oftentimes it's a no for right now. And so, get yourself some good CRM to keep track of everyone, and occasionally do updates and occasionally reach out. And sometimes at that right moment, it will click for those angels.
And Victoria, and you mentioned relationship management, but how, as a early stage business owner, how are you going and finding, these investors? Are you going to networking events? How do you suggest you actually even meet people that would fall into this category for them?
Yeah, I think all of those. Certainly entrepreneurs are the greatest source of advice and introductions for other investors. So going to all of the various entrepreneur events can be very helpful in figuring out who are the investors that are investing in companies like yours or concepts like yours. And once your friend entrepreneur has been funded, they can make that introduction to those investors. So there's a lot of that, of course, that happens. And then there are a lot of events. There are a lot of various demo days and a lot of events out there, I think, that you can start getting exposure. And then again, bringing on the advisors, because advisors will open doors to other potential investors. So I really think building that sort of advisory network is very helpful as well. You can certainly go down an accelerator path. Some sort of program that has a demo day at the end can be helpful. So there are a lot of touch points like that you can pursue.
Great, thank you. Rox, moving into your passion area, the SBA has a lot of funding options. Can you speak to some of the common ones and what are some of the key considerations for them, and why they just, they're great, especially for a growing business owner?
Yeah. Fundamentally, SBA loans are loans, and you have to be in a position to make a payment every month. And the primary rule for SBA loans is reasonable assurance of repayment ability. So that is the public objective. You have to demonstrate the ability to repay the loan. The other thing that SBA does is it allows a much longer term. So, for example, you might not be able to get a working capital loan from a bank early stage, but with that SBA guarantee, not only can the bank help minimize potential default risk or loss given default, they also can offer a much longer term, up to 10 years. So the first place I would start, depending on where you are in your cycle, if you're, a true startup or you're in your first few years, the SBA has a community advantage program, and they're designated lenders. Most of them are CDFIs, in fact, and they can make SBA loans from $25,000 to, I think, $250,000, maybe $350,000 now. But and they will typically do cash flow, look at cash flow projections, and these loans are regular SBA guaranteed loans, so it's not a separate program; it's a separate lender, right? So they are doing a lot more, again, as we talked about, training and coaching, to help you get going and to help you expand. That flagship program is called the 7A, and it's a guarantee, and that guarantee can be 50% 85 depending on the loan amount, 75% is the normal, and even 90% for export finance SBA products. But the lender is able to make those loans up to $5 million. So, you might have an SBA loan at different parts in your business life cycle, right? That doesn't mean you need an SBA loan every time, but it can help you at different points in your life cycle. Your business doesn't grow in this nice straight upward line. It usually grows kind of in steps. And a great place to get an SBA loan is when you're about ready to hit a growth spurt. So right when you're going to take that next jump in revenue, getting an SBA loan to help you finance working capital for that growth or any capital expenses, that's a great time to, plug in that product. And again, the advantage is a longer term, which makes the monthly payments smaller, makes them easier to digest while you're in that fast growth phase of your business. Let's see. The SBA lenders can use projections, so that reasonable assurance of repayment ability can be based on a projection. The important thing is that most SBA lenders are looking for your ability to repay from cash flow from the business within 6 months. So it's unlike an equity investor who has maybe a longer payout or repayment horizon, or exit horizon, I guess is the right term. A bank, you're going to have to be able to make that payment every month from the cash flow of the business. And the other thing I will tell you about SBA lenders is that SBA gives us, kind of a program that's this wide, and every lender decides where they're going to fit within that program risk box. So you will have lenders that would never do loans to startups. You have lenders that might do some. So you have just a really wide variety. And I would tell you, if your bank of account does not do that kind of SBA lending, look around, because many SBA lenders are also transactional, meaning they won't require the full banking relationship to do a transaction. So there's about, I want to say there are getting close to 2,000 active SBA lenders. And there's probably about 3,500, I said 1,000, 3,500 lenders who have licenses, but there are about 2,000 that are actually very active. So look around.
Great. Thanks, Rox. And actually, there was one or two questions in chat I just think are easy to just stay on really quick. Can SBA loans be used for software startups, which you kind of hinted at?
Well, it's not what you sell, it's where you are in the cycle. And remember, you have to have the ability to make the monthly payments from the cash flow of the business. So if you're, 6 months out from being, to a positive cash flow, that might be a good fit. If you don't have any revenue, if you don't have any, if you don't have a positive monthly cash flow stream, bank financing, even SBA, is probably not a good fit. But just because you're a software company doesn't mean you can't, borrow from the SBA. It's not what you do, it's where you are in your cycle.
Great. Thank you so much. So Victoria, switching gears and getting into really the VC piece of this, a lot of founders are interested in raising venture capital. What are some of the key things a founder needs to know if they want to use this option for funding?
Sure. And you know what? Before I jump into the VC, let me say one more thing on angel funding, because I feel like I have a few more things I can, because so few people had accessed angel funding yet. A couple of good resources for those out there. There are a lot of angel groups, and a lot of them have just applications. So you don't have to have met them ahead of time. The ACA, the Angel Capital Association, is a great place to find lists of angel groups. If you're in Europe, the UKBAA, the United Kingdom Business Angels Association, is a good resource. And I'm sure there's some other large ones like that. And then just look at the angel group, what the requirements are. I tend to think that angel groups, when you get group think, you get a little more risk averse, because versus an individual angel, they may take that leap and believe in you. I find that when there's a group, you do want to be a little further along, have a little more product market fit, so that there's some real metrics and data that a group can sort of parse out and get behind. So I would recommend going to the angel groups once you really have some good validation points. But a lot of them are Astia. You can just apply, and anybody can apply. We look at everything. And in fact, I will say there's no pipeline issue of women-led deals. We saw $2.6 billion worth of opportunities so far this year. So there's a lot out there, but I definitely think it's worth it to apply to those groups. Then moving on, once you've had that sort of angel funding round, or you're at the place where you really have some real traction going and you're ready for that influx of capital to scale, that's a good time for venture. Now, I caveat that a bit because there are some earlier funds coming out. So venture has really widened where the space that it's playing in. But in general, to get the VCs on board, usually, depending on what sector they want a certain amount of real traction. And what they're looking for is, if I invest now, can we now scale this? So, have all the kinks been worked out in the early amounts of the business plan and the product and the offering, and do we know who the market is and all of that. So at that point, again, a lot of relationship build, of course, a lot of warm introductions from fellow entrepreneurs are very, very helpful. And what you're looking for with venture, what they're looking for is the ability to really scale, and scale quickly and scale sizably. So some businesses are not cut out for that. You want to be a business where your growth is going to have that hockey curve, because as Rox was saying earlier, the investors, they aren't looking for little payments along the way. They are looking for a massive payout, 5 years down the road, 7 years down the road. And so they're looking for the big exit where you're selling your company to a much larger company, or they're looking for that IPO where the value of their stock will be substantially higher than when they came in. So not all companies necessarily want that kind of growth. There are certain business models that where you just want to build your revenues, and the revenues you can reinvest, and you can grow in a reasonable way, and you can be highly, highly profitable. And that's fantastic. That's just not the right fit for venture, which is okay not seeing anything until it sees a lot.
Great. Thank you so much. There's a few questions coming in on angel, but we'll leave those for the end, just because I think we can keep this going. And I think you kind of led into this perfectly, but venture capital isn't right for all entrepreneurs at all stages. And another option for funding is, traditional bank loans. Rox, can you talk to what are some of the requirements to get a loan for our founders, and how can they set the foundations for this early on?
Yeah. So besides a business checking account, yes. These are, I've been doing small business lending for over 30 years. And so, I have a pretty good idea of the places where young companies who say, I cannot get access to capital, tend to have a hurdle. And the number one is business accounting. Start learning now. I can't tell you, how many resources there are now online. Some are free, some are for fee. You can take classes at your community college. I feel like financial management literacy there's a little bit of a shame factor going on. You have this great idea and you know everything about it. Your market, your marketing. You know how to make your widget, you know how to sell your widget, but that financial piece is this little thing that's on your shoulder that's, not where you're comfortable. And that is not uncommon in all the small businesses I've worked with. It's rare to find somebody who knows how to, who has that skill along with all these other skills. And obviously when you're first starting, you don't have the capital, and it doesn't make sense to invest in a full-time employee, perhaps. So, I want you to get smart about accounting, so that you can get your, develop proper business financial statements, because your financial statements are your scorecard. It's how we lenders and even investors evaluate your company. And it tells us something about your financial acumen when you have proper business financial statements. And using accounting software like QuickBooks is very acceptable. It's a great way to get your feet wet into this. Most businesses don't have complex accounting structures that warrant anything that would, require something more sophisticated. Although, many accountants use QuickBooks too. And the other thing about that, your accounting software is you want to work with someone who does a lot of training and has add-on services, whether it's payroll, whether it's bookkeeping services, or whether it's just someone who can help you set up your accounts so that your financial statement, your balance sheet, and your P&L are organized properly according to generally accepted accounting principles. The other thing I would tell you for new businesses is cash flow. So EBITDA is not cash flow to a financial, banker. So I really want to know how well you know your cash burn. Are you generating cash in, cash out? And I'll give you an example. You want to do a forecast that shows your cash receipts and your cash expenses, and you want to update that forecast monthly. So you always have a good bead on, not from an accrual accounting standpoint, I'm going to use accounting term, but truly from a cash in and cash out. This is particularly critical if you don't, if you have to sell on terms, meaning you sell your goods or services and you don't get paid for 30 days. That's called a receivable. The fact is you have to finance that receivable. So you have cash tied up in that. So maybe you made a sale today in January, but on your cash projection, you don't get that income until February. But you have a bunch of expenses in January that aren't covered by that sale that was made in January because the cash doesn't show up into February. And that's really what a cash, really good cash flow forecast can help you. And this is also really important when you're growing rapidly. You really need to keep an eye on cash, and so when we talk about, is your business profitable, that's really important. But what if your business is not yet profitable, but you have revenue? What's important is what your cash forecast looks like and how well your business is generating cash. And let's see, I think that's everything. Oh, I know what I wanted to add. A line of credit can be really helpful if your cash cycle, if you want to bridge those receivables, that's a great way to use a line of credit. What is not a great way to use a line of credit is for permanent working capital. So if you sell that product today and you're not getting paid for another 30 days, but you need to cover some of your operating expenses, when you get paid, pay down your line. It's a cycle. You draw on your line, you pay the line back when you get the receivable. And so many businesses that I see have gotten multiple lines of credit from multiple institutions, and they don't revolve. And what they really needed in the first place was permanent working capital, equity, and equity can come from multiple sources. It can come from reinvested profits if you have them, reinvested cash. It could come from friends and family. It can come from other investors, and it can come from your own pocket, your own, investment of your personal capital. But that's probably the key things that I see that prevent, viable businesses, from getting capital.
Thank you so much, Rox. And Victoria, I'd love to give you a moment if you have any comments you want to add to that. I think the financial literacy piece probably speaks to all, right?
Yeah, I mean, certainly as you get to venture, and even angels will, really dive in and want you to have a thorough financials and budgets. And at the angel stage, we know that your projections are not going to be accurate. They never are.
Yeah.
But we want to see that you've really done the rigorous work of what are your assumptions and how have you projected that out, and what is the model. We want to see a financial model of how you believe you will grow, and what we're looking at that stage is, does this make sense? Because we know things are going to change. We know as you actually get out there in the market, you're going to realize that this strategy is not working and you're going to pivot over to this strategy, and all of that is expected. But did your assumptions behind all of the numbers make sense? As you get to that next stage, as you're doing your real, that real equity raise past that initial seed round, but that seed plus round, or the plus round, or the A round, because there's so many silly terms being thrown around. At that point, you're going to need a real CFO, and it could be outsourced to start out with, and then after the A, you bring it in-house. But you really do need that rigorous financial planning, and we need to see that the company knows its cash burn. That's always a question, even from the early stages. What is your cash burn? Because too many businesses have failed because they ran out of cash. They were doing great. They had a great concept. They had a great everything. They just didn't manage the cash well. The other thing that happens with companies that have angel investment, oftentimes the company will need to do a bridge round, right? The company's not quite ready to do its next equity raise, but it's running out of cash, and it will go back to those early investors and say, hey, can you do a convertible note to bridge us to that next round? And it's one more reason why it's important to keep your investor relations really, really strong. So after you get that initial funding, be in touch with those investors, give them updates, even when things aren't going well. Transparency is really important, regular communication, because your early investors want you to succeed, right? So they will step in and they will bridge you if you've mismanaged cash or if something else has happened that wasn't at all, you're doing. But they will do that more willingly if they've been on the ride with you the whole time. So those are just a few things I'd say about that. But I agree completely to get the accounting set up right away, be on top of it. It may be you doing it yourself for a long time, but then bring in the outsourced. And there are more and more of those outsourced CFO companies that can be fairly reasonable in their pricing. So.
Great, thank you. And sticking with you, Victoria, you kind of hinted at it, but accelerators are a common avenue for founders to find funding and get off the ground. And you actually, I know Sharon used to run one. Anything to comment on the upside, downside of them?
Yeah, I think accelerators can be great. It depends on the accelerator and what you need. So I would definitely do your due diligence. I would talk to other entrepreneurs who've been through the accelerator. Some accelerators take some amount of equity, and that can be okay if the benefit that they're providing is substantial. Some don't. Some do not take equity. Some, they're all different structures. So be sure you know what you're agreeing to going in. Think about what the longer term implications are. I recently heard of an accelerator that had a side letter that really kind of continued their benefits for a very long time. I thought perhaps inappropriately too long. So kind of think down the road of what you're giving up now. But one of the questions I would ask is, what kind of connections are going to be made? That's a big part of the accelerators, who you'll be introduced to. So some of the corporates have really exciting accelerators now that really connect you into the corporate. And if your business is aligned, then that can be great for, your first customers may come out of some of those connections. Some do a great job of inviting in other investors. And so again, that can be very, very beneficial. So I would just look at what are the upsides. It's really particular to each accelerator. And then what are you giving them in return, and how much of a cost will that be down the road, and is it worth it? So, they certainly also are helpful in providing structure. They kind of force you to do your homework and show up. And so that can be really helpful, but they certainly aren't necessary. I know plenty of companies that have not gone the accelerator route. So.
Great. And then, an overwhelmingly low amount of capital is flowing to underrepresented individuals as well as female founders right now. How are you both approaching this in your business, and how can we all help move the needle? Rox, I'll start with you on this question.
Well, as you know very well, Bank of the West is supporting women-owned businesses and entrepreneurs in ways that go beyond banking, particularly through partnerships like with the NASDAQ Entrepreneur Center. We can continue to educate and inform this particular community on how they can access capital and be a resource as well as a bank, to these businesses. We continue to build our library of information to support you on your journey. We publish a Means and Matter. It's a digital publication that continues your education. And we continue to invest in organizations that drive gender equality and create women leaders. For example, we recently invested in Grameen America, and where our contributions have led to creation of 12,000 women-owned businesses and 22,000 jobs. And I don't know, Paloma, when we did that. I said recent, but I think it's been a little bit.
Yeah.
Yeah. And we also continue to support several CDFIs that help fund and start up women-owned businesses, particularly in the San Francisco Bay Area. Working Solutions is a CDFI that's been around for quite some time, with a focus on women entrepreneurship. And I know that Paloma and Bank of the West has a lot more things in the works that will help you on this journey.
Great. Thanks, Rox. And Victoria, obviously, Astia has a huge focus on this. So
yes, it's so important to us, and it's really important that we get it right. And I think we're the first to admit that it's challenging. We've learned a lot from mistakes that we've made, and I think it's constantly a source of area that we're extremely committed to. So we're about to actually publish a white paper on some findings that we had. When we launched the Astia Edge program, we launched it as a pilot, and specifically we had a pool of capital that we committed to investing in Black women CEOs. And the findings out of that, we're now publishing a white paper, but it just became so clear how much more challenging it is as a Black woman CEO and as a Latinx woman CEO to raise funding. And for one of the things, we collect data on everything. So for most of our companies, we make 5 to 6 introductions to other syndicate investors, and the round is filled. For the Black women CEOs, it was 60. That's how many more introductions, because there's so many layers of bias that are at play. One being that the bar is higher for those CEOs. And so I had conversations with syndicate investors where somebody would say, well, the KPIs aren't what I want, and yada, yada. And it sounds very reasonable and rational, except you think, wait a minute, if this were a white guy, you would be investing like that doesn't, this is a different bar. This is a different set of standards. You see investors investing in more of the vision of what a male CEO, and particularly white male CEO, will provide. And for a Black woman CEO, it's based on what she has achieved today, not a day further. So we found many things like that coming into play that are really, difficult. You really have to unwrap that onion and the layers, and there's a lot in there to unpack. And we found that we had to be real advocates. And there was a lot of advocacy work needed to get some of these investments across the line. These fantastic businesses that, for no other reason, were not being funded. So we are going to be publishing that, and we continue to do work in that area. And then we are raising additional funds so that we can continue that work through that Astia Edge. And the purpose of that is being that really early stage funding, because we have the fund that can come in at the Series A, but we need something before that. So that's the work we're doing, and we are trying to be vocal about it and get others on board, because we just all need to be focused on this and committed to this. It's not an easy thing that's just going to go away.
Great. Thank you so much, Victoria. And I can't wait to read that white paper. I think it's just, again, it's so interesting. And I love that you guys have been able to do some additional research on that. So before we go to Q&A, one piece of advice from each of you that you have for our community of founders. Rox, I'll start with you.
Like I said, from my topics, I'm very passionate about financial management literacy. And even if it's not your thing, you have to know enough about it to tie how your business is going to grow and expand you have to tie that to the math, and get smart, take training. There's a lot out there.
Great. Thanks, Rox. And Victoria, your one piece of advice?
I think just remember to keep taking care of yourself through all of this and fill your needs. It's a hard journey. It's a long, long journey, but it's an amazing one. So whether that's finding your community of people that will kind of keep you bolstered, or just making sure you turn off the computer at some point and take a walk and go away and walk a dog or go play with your kids or whatever it is, just take some time and make sure that you give yourself the love that you deserve to.
I love that. Wellness is not a nice to have, but a need to have. So yeah, thanks, Rox. Go for it.
Yeah, I wanted to add something to that again, because this is another thing. I don't know, Victoria, if you see this, remember to pay yourself.
Oh, yes.
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 When you build your projections, your budgets, your forecasts, please pay yourself. You will never pay yourself if you don't put it in your forecast.
I just had that experience with an entrepreneur. We'd already funded her. She had funding. And I found out that she hadn't been paying herself. And I said, okay, no, your next board meeting, this has to change. You cannot not pay yourself. You just raised funding. This is crazy. Yeah.
It's important.
So let's turn to some of the Q&A that we've been getting. Victoria, any feedback this group had gone to a prior presentation from NASDAQ, and one of the feedback pieces they got is that angels don't invest in CapEx startups. Any tips for navigating this, or are there angels out of the picture for brick and mortar startups? Thanks.
Yeah, so the brick and mortar, the reason that you're going to have that hesitancy is because of what's the scalability of it, and something very brick and mortar may have it. It can have that big scale, but it's much more expensive and it's harder to do versus something that is easily replicable or has a virality, or doesn't. It's just about growing users and not about building out space and all of that. But it's not to say that there aren't individual investors who will invest in that, and it's certainly not to say that there aren't groups that do that. It's just your typical angel group is looking for a different model for the most part. But, as an example, like a restaurant, for example, is not really what you would think of as an angel-backed business. But I know plenty of angels who have invested in restaurants. It's just because they like it and it's exciting for them and they do it. So I would say, keep the conversations open, but probably going to the typical angel group won't be successful. But there might be angels in that who would be excited about what you're doing and will make an investment.
Great. Rox, one of the questions we also got, it's a little too specific probably, but on current SBA interest rates, but also the big thing that came out was, does SBA require personal guarantees?
Yeah, that's a good question, actually. SBA does require personal guarantees, and this is important if you're getting any bank financing, because most banks require personal guarantees. So the typical guarantee, whether it's SBA or non-SBA, is anybody who owns 20% or more of the business is going to have to provide a personal guarantee. And that, like I said, that would be for conventional and non-conventional loans. Commercial loans and SBA loans, you're going to need it. And the other thing about interest rates, one of the things about SBA is it has caps on those interest rates. So unlike some, other, non-SBA, non-government guaranteed lenders, the SBA has said to financial institutions, you have something here that's going to mitigate your risk. So we would like something back from you. And one of the things that we give back is that interest rate cap. And for the regular 7A program, that is a prime plus 2 3/4, prime plus 2.75%. And that's Wall Street Journal prime plus that spread. Most SBA loans are variable. There are some financial institutions that will do a fixed rate 7A loan, but typically not until you get to real estate, right? The SBA Express program, that is prime plus 4.5 for loans over 50,000 and prime plus 6.5 for loans under. And again, when you think about, some of the, actual annual percentage rates from, other, non-bank lenders, the SBA caps really make capital more affordable.
Great. Victoria, we've seen a few questions in the chat around grants. Do you have any thoughts on where people should be looking for them? I've seen them also being specific, like Hispanic-owned businesses, Black-owned businesses. Thoughts on where to find?
Yeah, no, I'm more familiar with more of the ones in the medical field. So
specific, yeah.
So I am not a specialist on that, so I don't have great advice for that. Yeah, I think your Google search would be as good as the advice that I could give.
Right.
But yeah, when I said the grant funding, I was thinking more on the medical side, where that's very common to get those early grants for research and all of that kind of stuff.
Great. Well, we could definitely maybe follow up on that question from the NASDAQ Center. So thanks for those who asked about that. Roxann, another question that came up was on factoring. Maybe if you have a little quick primer on what is factoring and like how a business owner can use that.
Yeah, factoring is basically when you have receivables, and particularly if your receivables are from a large company, and that means you've sold your product to a large company and they are going to pay you, so many months from now or so many days from now. You can actually pledge that receivable. So let's say, I'm just making this up, so don't quote me. Let's say you have a receivable from Costco and they're not going to pay you for 60 days. You could take that receivable from Costco and pledge it to a factor, and they will then give you a percentage. Let's say the bill is, $300,000. Well, they may give you an advance on that particular receivable to, for that particular sale, to Costco, because Costco is a credit grade or, a low risk payer, if you will. And so they'll give you an advance on that. And it's very companies that do factoring, they are very focused on the quality of the receivable, meaning who that customer is and will they actually pay you when they say they will, so that they can get paid. The other thing about factors is the money doesn't go to you. So when the Costco pays you, the money goes to the factor directly. They take their money off the top plus any fees, and then they give you the difference. It's I would say factoring, like letters of credit, are something that you do at a point in your, depending on the type of business that you have and at a stage in your company, because, it's expensive,
Great. Thank you. One of the pre-submitted questions, I think it's just a great one for both of you. How do you get funding if you have no capital?
Well, I'll give you my 2 cents, because, even the SBA program where, a lot of risk is mitigated, the small business owners have to have skin in the game. They have to have capital. Now, most financial institutions for a pure startup are going to look at 25%, equity investment. You may be able to do something lower than that. So when if you say, these are my startup costs are $1 million. All right. This is my startup costs, including working capital that I need to cover that gap in cash flow. If it's $1 million, you're going to need to get 250 in. You may find a CDFI who will, do the loan with a lower injection, but at a minimum, SBA requires 10% equity injection on startup businesses by program, rules.
Great. And Victoria, your answer to that question?
Yeah, I think a lot of people start their startup and they hold a job, and they have to do both. And you're, doing it in the evening and the weekends, and trying to balance it out as you can, as long as you can. And then hopefully at some point you have enough going with the startup that you can convince 1 or 2 individuals to do a convertible note with you or a safe, and start to build that way. But it certainly can be a slow start. It may be drips and drabs that you're getting that money in the beginning. So planning out how you'll get through that yourself is really important, and what you need to do to balance out to get your own income that's expected. I think at some point, when you go to an angel group, at that point, they'll probably want to see that you're full-time on this to give you some funding. But leading up to that early, you can certainly be working multiple jobs.
Great. Thank you so much. We're just about at time, so I will turn it back over to Colin, but I think there were some great takeaways from here. I think we both heard from Roxann and Victoria the importance of understanding your financials, but also understanding all the options. There's clearly a lot of different paths you can go, and multiple paths. Having that advisory team, Victoria, you said that so eloquently, and I saw so many positive comments when you both highlighted pay yourself. It's so important. So thank you so much for sharing your expertise and insights. And Colin, back over to you.
Awesome. Well, thank you, Paloma, for moderating such a great conversation with Rox and Victoria. Rox and Victoria, thank you so much for sharing insights on the funding options out there for our entrepreneurs in the audience. Really appreciate it. And for everyone still on, we'd love to hear your feedback. So we just dropped a survey in the chat to let us know what you thought about this event. Also, what sort of content you would like in the future. So Paloma, Rox, Victoria, thank you so much again for joining us, and for everyone in attendance, thank you for joining us online. We've got some great programs coming up in the coming weeks, so make sure to keep your eyes out for those. So on behalf of everyone at the NASDAQ Entrepreneurial Center, have a good morning, good evening, and good afternoon, and we look forward to seeing you online soon.